Good morning, my name is Przemysław Kwiecień. You're watching XTB weekly trading webinar. Today we'll discuss stock selection. Actually, we'll discuss which US stocks look most favorable right now based on the model that the big data model that we have prepared recently. But actually, today we are going to discuss much more than this. We have a very interesting market situation right now where on one hand, you have quick rebound from the pandemic recession, but that rebound comes along with surging US inflation, which you'd think would be negative for bonds, would be negative for equities, but meanwhile, something exactly opposite takes place. Despite US inflation reaching 5% in May, US stocks are at their all-time highs, with S&P 500 opening, S&P 500 futures, US 500 opening at the new highs this morning, along with D30 again at all-time highs. So why is this market sentiment so good? Why are investors so happy despite the higher inflation? Well, over liquidity explains it all. We'll discuss this in a minute. Also, with money looking for places to be, because there is 0% yield on the short term, commodities are really in the spotlight again, especially industrial commodities. Both oil markets are way above 70 at present, with demand situation looking good and supply constraints still present. This week the focus will be on the FOMC meeting that we'll have on Wednesday in the evening, 7 p.m. We reported for you in the news section of XTB trading platform. And also investors will look at US data that will be released one day prior to the FOMC meeting on Tuesday, retail sales and PPI, but obviously the most attention will be grabbed by the FOMC meeting itself. Okay, so let's take a look at the market situation, and like I said, what's a real explanation behind this great sentiment that we see despite the data, pretty much regardless of what we get, whether it's a weaker NFP, whether it's high inflation. You can see all the time the same response from the market, which is higher indices, which is still tame bond yields, as pretty much the money has nowhere to go. What you can see here is reverse repo operations. These operations are conducted by the Federal Reserve of New York just to maintain short-term overnight US dollar rates above 0%, or pretty much at 0%. So all the funds, all the institutions are parking the money at the Fed at zero, in record amounts, as you can see here. Previous episodes of high over liquidity were between 2016 and 2018, beginning of 2018, when the Fed began actually shrinking their balance sheet for a short period of time. And as you can see, there were only short-term spikes in these operations, usually some end of months, special cases, but normally, even then, even during the whole QE period, the over liquidity hovered between 100, 150, 300 billion US dollar, whereas right now we are at 550. So obviously huge records day after day, pretty much. So the explanation is, despite this inflation you can see here, that is being propelled by a broader range of things. Obviously, yes, the transitory argument has some ground here. As you can see, fuels, used cars, obviously they made a big chunk of this inflation increase. However, as you can also see, there are other categories that are present, where like apparel, like house furnishings and operations, they also gain relevance here. So most likely scenario is that in coming months, these special categories that are contributing the most to the increase in inflation, they will start fading, and the headline inflation. Headline inflation might actually be even higher in June than it's right now, but from that point it should start declining. But these other categories, they may actually start contributing a bit more. So the headline, quite simply, might not decline as much as it was before. So that's the main story, and that should be a concern for the markets that is so addicted to 0% rates. But right now, like I said, with so much over liquidity, quite simply, investors learn hard from the April case of higher inflation, that even if they sell equities or even if they sell bonds, where do they go? There is nowhere to go, so investors quite simply, they add to the exposure. So the only thing that may change this is the fact they need to start withdrawing this excess of liquidity. Otherwise, the bubble is going to, increase in size until something happens. Looking at market sentiment, one factor that should be noticed is that put-call ratio is at the lowest point since January. So the option market is very hot right now again. Overall sentiment, which is this red line, is also quite stretched, but not as much as it was a few times already in this bull market, and only once over here very extreme level actually led to a sharper correction. The level that we are at right now, yes, it also had some impact, like let's say here, but like I said, with this over liquidity, even if there are indicators showing that market is stretched, it doesn't automatically mean that you'll have a correction tomorrow. Let's take a look at indices. As you can see, we are opening at the record levels today. Especially Nasdaq is doing great. I think we discussed about this second double bottom on the US 100 3 weeks ago, and since then the market rocketed higher and is testing all-time highs. Also, the German DAX is doing very well. We were in this broad range in a longer upwards channel, and it looked like the bulls were struggling. However, eventually they managed to break higher, and now this previous upper zone, which is around 15,500, it makes up for support right now. So the positive bullish momentum is still present, even if the market is no longer as as dynamic as it was between March and mid-April, let's say. So it's still in this broader bullish environment. And like I said, even if you have some signals, you need to have a trigger, which would be a decline, significant decline in this over liquidity. So it's obvious for everyone that the Fed needs to make a move in order for markets to budge. We'll return to this towards the end of our presentation. However, right now let's switch our attention to the story of the week, where I would like to present our latest model for US stock selection, which is based on big data. At the beginning of the year, we presented top 10 report with stocks that look good based on the indicators. However, this was like a semi-manual approach where we look only at annual data and a shorter time period, and yet the stocks that we presented at the beginning of the year that were kind of meeting the criteria, they still outperformed the S&P 500 on average, quite significantly actually. So even though the market has been strong this year, these stocks were doing even better, 50% better than the market. So I think it's a good result. But now we took a more detailed, like a full-time big data approach, where we looked at all the S&P 500 stocks from the past 30 years and a quarterly data, and we And each quarter we looked at the at 10 stocks that performed the best over the next 5 years time period, and we look which characteristic they had. So so just an example, for instance, stocks that pay no or very little dividend, they do well. Stocks that have low debt, they do well. So we looked at nearly 90 indicators, obviously not looked with our eyes or not looked manually, but we employed a big data model that analyzed the numbers and crunched them to show us that these 10 indicators, mostly related to book value, to revenue growth, to dividend yield, which ironically needs to be low in order to select a good stock, and to debt levels and cash coverage. So these were the characteristics of the, let's say, winners for the past nearly 30 years in the US. So not going into mathematics because it's a bit complex, we take a look at which stocks have this characteristic right now, and the list is here. I can show it. Here you have all the present indicators. So I'll leave it for a few seconds for you to take a look at. And here is a description. As you can see, these stocks are mostly technological stocks like Apple, which you may know very well. So yep, to all of the critics that Apple is already very inflated stocks, yes, but it meets the criteria of a winner. But also you have some well-known IT stocks like Nvidia or AMD or Adobe, and less known technological stocks like FTNT or Teradyne, for instance, or Autodesk. So pretty much the Home Depot is the only clearly non-tech stocks here. So you might be on alert, saying that, hey, look, yes, maybe these stocks have good characteristic, but their prices are already very elevated. Let's take a look at Nvidia, that is doing a phenomenal job, or Fortinet, or AMD, or Adobe. Everything is, it's literally exploding. And looking at past few years, these stocks look very, very expensive, and this is true. And it is also true that the stock selection model, the only period of the past nearly 30 years where it didn't do well, was at peaking stock at the top of the dot-com bubble in 1999 and the whole 2000. So it's likely, we need to admit that if these high valuations end in some kind of sharp correction, that the present peaks may share this sad fate. However, the approach should be not to treat it like a single investment, but rather than treat it as a strategy of investing in winners quarter after quarter. And then even if you pick a very expensive stock or few stocks in a certain quarter or 2 quarters in a row, then if you stick to the strategy, keep investing quarter after quarter, you will be also picking these stocks during the periods of the bear market or lower valuations. So over time, we think this methodological approach based on the data might actually be a better idea than just picking the stocks manually on what we think should happen. And this, like I showed with this dividend example, is very often not the best approach. All right, so let's return to the FOMC and what the Fed will do this week. So basically, this is going to be a very crucial meeting because everything depends on the Fed right now. We have seen that regardless of what the data is, the market is just going higher because there is this over liquidity. So the question is right now, if the Fed has a courage to deflate this a little bit. Looking at the inflation and the pace of recovery, they should at the very least start the discussion on limiting quantitative easing. Will this happen? Well, we don't know with this Fed. The previous FOMC, of even older, I would say older, not in terms of age, but in terms of what happened before, early, or maybe early Jay Powell, not the one that we had in 2017 and 18, this Fed would already taper. But right now we see how different this Fed is. So having that in mind, you never be sure. They should start a discussion on tapering, and they should announce it like, okay, we see the economy is improving, then inflation is rising, we think it's transitory. Of course they will say this, but we will start the discussion on tapering. So this is what the market should expect, and the lack of such statement would be another argument for this bubble to keep inflating. The other thing that you should have in the back of your mind is a possibility of rising interest on excess reserves, which is here, which is right now at only 0.1%, and this is a rate that banks receives on their reserve at the Fed, and if this rate is increased even slightly, it could solve the problem of over liquidity, because the banks would offer some positive rate to money market funds. I don't think they will do it, even if it's technical move. They will be worried that this will be seen as a hawkish, and they simply were avoiding such impression very hard over the last few months. So they should do it. Technically they should do it. It's necessary, as you saw at the beginning of the presentation. This over liquidity is a real problem and it's distorting markets greatly, but like I wrote here, the chances are below 50%. Anyway, the meeting is on Wednesday, the decision is 7 p.m. And press conference starts 30 minutes later, and we'll report it for you in the news section of XTB platform, including the mobile one. So you're very well encouraged to watch it. So that's it for today. Thank you for your attention. Have a great week. We see each other next Monday at 7:30.